Good morning, everyone, and welcome to today's webinar, Premium Financing Designs for Rising Interest Rates and Potential Tax Reform, sponsored by Verite Group and Lion Street. We are excited to welcome Michael Seltzer and Michael Fontanini for this presentation as a follow-up to their top-rated workshop at the 2016 AALU annual meeting. As an aside, if you have yet to register for this year's annual meeting, you can do so at aalu.org. Their 60th anniversary is going to be definitely an amazing event. If you have specific questions about AALU's official positioning on issues addressed on today's call, please forward them to communications@aalu.org. Now for a brief introduction of our presenters. Michael Seltzer is a founding member of Verite Group with over 40 years of experience in the life insurance space. He has focused his career on serving the insurance needs of high net worth individuals, businesses, entertainers, and athletes, as well as with publicly held companies on executive benefit design. Michael Fontanini is Director of Advanced Sales with Lion Street Incorporated. He specializes in helping Lion Street firms develop sophisticated life insurance solutions encompassing both planning and product design to meet the sophisticated needs of high net worth and business owner clients. A reminder to all participants that this webinar is meant to be interactive, so if you have a question for the presenters, please submit it using the Q&A feature on your control panel. With that, Michael, I turn the floor over to you.
So thank you, Jordan. Good morning, everybody. It's Michael Seltzer here. So for those of you that did see us at AALU or the forum last year, this is going to be a little bit different presentation. Our intention is exactly what the title talks about. What's happening with rising interest rates? How does it affect premium finance? What's the long-term look like for that? And also potentially there probably will be some tax reform. We are not going to today to opine on what we think tax reform is going to look like. Candidly, we just don't know. We've been watching everybody else talk about it, and it doesn't seem anybody really knows. But we do want to talk about some ideas that would be appropriate for premium finance if there was an elimination of the estate tax. And we're going to cover that. But mostly what we're going to do is really dig deep into design. And specifically, we've been seeing a lot of stuff over the last year or so that we think is reckless in terms of premium finance. We're going to talk a little bit about that. So this is really not meant to be premium finance, one really a little bit deeper dive. But to start off, we'll just cover a couple of basics about premium finance for those of you that may not be familiar. So premium finance is really premium finance is really a structure where a qualified borrower accesses third-party financing, or said a different way, we have a client that is a high net worth, ultra high net worth client, needs to buy a lot of insurance, probably can afford to pay the premium, but chooses not to, so they have the ability to take those funds and reinvest them in their businesses. We're simply taking leverage to buy life insurance. We have been involved in financing whole life, UL, IUL, predominantly IUL and whole life insurance, and typically showing ways to purchase insurance using minimum cash flow, minimum disruption of current assets, or cash flow. We have, in our organization, we have lots and lots of banks, and they range from the large lending banks like Northern Trust, Bank of New York, Wells Fargo, to smaller banks that probably most of the people on the line have never heard of. And structured properly, premium finance will help reduce cost, increase policy benefits, minimize opportunity costs, increase flexibility, or some combo of all. So again, just to reiterate, probably what most people on the line know, premium finance is simply a methodology of applying leverage to pay for the premium. So typically the client can take those premiums and reinvest it in their business. Ideal clients should typically have a net worth of at least $5 million. Now, the $5 million is really a standard set by the life insurance industry as well as the lenders. We typically don't go much below $5 million, but in all candor, the real typical client has in excess of $20 million in net worth. That's really the sweet spot. The client will have some legitimate need for death benefit. It might be estate taxes, it might be supplemental income, it might be charitable giving, all the things everybody on this line is, used to selling insurance for those needs. Same thing, just using leverage. One of the things that we've discovered that we'll just share with you is that what we've discovered is that when you're dealing with people that are wealthy and they've used leverage in order to create their wealth and their net worth, they're very comfortable in premium finance transaction. In premium finance transaction. Alternatively, what we found is that people that have not used leverage to create wealth are very uncomfortable using premium finance to buy life insurance. typically a client is going to have a desire not to liquidate assets or redirect cash flow to pay premiums, may be concerned about potential gift taxes, and have a willingness to have some skin in the game. So let's just talk about that for 1 second, and we're going to do a deeper dive into this. For those of you that have heard us speak in the past, you've probably heard us talk about that we think every client should have skin in the game. And what we mean by that is every client should be paying some form of cash flow. We have come to a conclusion in the past year or so, which we'll share with you, that maybe that's not true anymore. Maybe there are clients that actually should not be paying cash flow, and we're going to talk specifically about that today. So we also are big proponents in that we should be talking about the risks in a premium finance transaction. We have a piece called the Discussion About Premium Finance Life Insurance, where we talk about all the risks you see on the screen. Candidly, we're not really concerned about many of those risks. In terms of renewability, we've never had a loan not renew. Technically, it is a real risk. Technically, a bank may not renew. But even if they didn't renew, there's probably other banks that would pick it up. So we don't talk about that a lot. What we do talk about is interest rate risk and policy performance. And we spend a ton of time in our presentations talking about what's going to happen with the interest rate on the loan, showing different patterns of growth, which we're going to attack in a few minutes, and talking about policy performance. Are we illustrating the AG 49 rate? Are we illustrating a percentile rate, which we'll talk about? And really, what's the combination of those two affecting the long-term performance of the policy? Rising interest rate, poor performance is going to have a really negative effect on the transaction, which needs to be disclosed. Interest rates that stay level or go down with policy performance going up is going to look really good. So we need to make sure that the client has a full understanding of all of that. So this is what we can take a look at now is something we would call a risky design, or a design that we would be very uncomfortable in selling. Michael, you want to talk a little bit about why?
Sure, absolutely. Why don't we take a look at a hypothetical example here and kind of show some of the common designs that we oftentimes see from other professionals out there, and highlight some of the potential concerns with the underlying assumptions. So what you're looking at right now is a ledger that we put together that kind of resembles a more risky design, like what we often see out there in the marketplace, that's usually predicated on more aggressive assumptions, such as what we would consider light or insufficient premium funding, just starting over there on the left. We oftentimes see premiums being paid for only 5 to 7 years or so, and the borrowing costs being projected based on a very flat projection, rising by something only like 10 or 15 basis points per year, and leveling off at something very overly optimistic, I'll call it. And then we oftentimes will see no cash flow, as Michael mentioned, being illustrated by the client in terms of out-of-pocket costs. So in column 8 there, we'll often see that column at 0, client paying nothing, rolling up all of the interest, illustrating the policy at the maximum illustrated rate, which under AG 49 does not necessarily concern us in and of itself, but it's more the relationship between the projected borrowing cost and the illustrated rate, and the spread therein that usually is more concerning to us as we're designing cases. And then at some point, though, we'll often see, somewhere between years, 10 and 15 or 10 and 20, a disbursement coming from the policy to repay the debt after the client paying nothing, with the long-term death benefit looking very attractive based on all of these underlying considerations. So the typical positioning usually goes something like, instead of paying premiums, why not post collateral? You won't have to pay any out-of-pocket costs, and you only have a 10-year collateral exposure, and then we'll exit the loan sometime between year 10 and 15. And although that could very well happen, depending on what actually happens in reality with interest rates and policy performance, the concerns of this design really are kind of along the lines of just the increased exposure to risk long-term, particularly the interest rate risk exposure, and the fact that paying nothing towards the loan really exacerbates all of the risks of the transaction and increases the chances that the policy will underperform. We oftentimes see this design presented statically in a vacuum, just like this, without showing any other hypothetical scenarios to demonstrate what could happen if things do not occur as projected. and probably most concerning, a lot of the times there's no other backup plans being discussed or implemented with the client in order to provide, as we'll talk about a little bit later, a backup source of repayment for the loan if the transaction underperforms and the policy cannot fully support the repayment as such. Which with a loan that's accruing by the full interest compounding every year, obviously that just increases the potential future risks and costs of having to repay the debt out of pocket or a portion thereof in the event that it underperforms.
So, and additionally, most often what we've been seeing is that this kind of illustration is being shown by people that typically are fairly inexperienced in the premium finance market, and or people that are intent on selling free life insurance. So these sales are typically arising from the whoever's pursuing it in terms of saying, you know, whether or not you need life insurance, this is a great deal because it's free life insurance. And most typically there's no stress testing, and most typically they run really, really thin. So the probability of them blowing up is really, really high. About an hour ago, we just got in a new case from New York where the agent actually, the premium was $2 million plus a year, and the people, whoever went to the client, I don't know who it was, actually showed an interest rate of 2% staying flat for 20 years, which is just totally unrealistic and not even realistic for today.
And just a couple other things too to add on top of all of that. One of the other concerns that we often see in these types of designs is the loan to value ratio at the point of the loan repayment by way of some type of disbursement from the policy. A lot of the times we see, as is the case here, where the loan to cash value ratio is in upwards of 90% or more from a design perspective. And in reality, that's just not feasible because of the increased stress and policy performance risk that will impose when taking disbursements from the policy to repay the debt. And then also, as you'll see here in a few slides later, that light premium funding can further exacerbate the collateral exposure long term if there's a couple down years in the early years, or if the policy simply underperforms. So that begs the question then, what are some ways we could stress test this type of design to see how it might stack up or hold up under maybe more reasonable or more conservative assumptions? So before we get into showing some different scenarios for that design, let's talk real quick about some of the various ways in which we prefer to base our assumptions for projecting borrowing costs and illustrated rates. This is our kind of personal philosophy, if you will. There's obviously other ways or mechanisms you can use to base your assumptions, but generally we like to use some type of quantifiable or objective measurement for supporting the underlying assumptions for the borrowing cost and the projected borrowing cost anyway, and the illustrated rate. So for borrowing costs, what we do is generally one of two things. We'll either look backwards and base our prospective assumptions through some type of historical lens. In that case, what we would do is look at what the historical average LIBOR rates were over the last 25 to 30 years, and then project going forward the loan interest rate rising up to either a 25 or 30-year historical average LIBOR rate plus the assumed spread based on the underlying loan terms being offered to the client. And the thought process there is that in the financial markets, things tend to revert to the mean. And so if we use more mean reversion perspective, then we'll project it up to either a 25 or 30-year historical average rate, typically over a period of 5 to 7 years to resemble interest rate cycles and things like that. And what you'll find and see as we walk through the presentation is using that assumption generally results in a projected borrowing cost long-term in the neighborhood of 5 to 6%, depending on the underlying spread assumed for the loan. The other way we can look at this is with a prospective perspective, looking forward instead of looking back. And when we do that, what we oftentimes will do is use what's called the forward LIBOR rates as the underlying scale for the projection. So the forward rates are really derived from the yield curve at any given point in time. And there's a lot of really helpful insight that we can derive by looking at the yield curve and then extrapolating the implied forward rates for borrowing costs at different points in time in the future that are essentially calculated through the yield curve itself. And the details of how those calculations are made are well beyond the scope of this discussion today. But just know that what it basically represents are the expected borrowing costs for loans beginning at different points in the future, based on loans of different maturities beginning today, or in other words, the spot rates embedded within the yield curve itself. This should really be, in our opinion, kind of the minimum projection for borrowing costs, because the forward rates really represent the market's expectations for future interest rates based on current market conditions. And as you can see here, looking at forward rate projections beginning at different points in time in the past, the forward rates can fluctuate over time based on market conditions. So if you're not at least projecting borrowing costs based on this type of an underlying scale or basis, then in our opinion, it might be a little overly aggressive or a little overly optimistic in terms of the projected borrowing costs. So now if we move on to the illustrated rate assumptions, again, quickly, we'll just fly over this. The details of how these numbers are calculated and determined are again, beyond the scope of this discussion. But again, using a looking back versus looking forward type of perspective, if we look back, what we'll often use is the historical frequencies, or the historical percentiles, as some refer to them. And what those really are the frequency in which rolling time periods would have realized a compound average growth rate of some rate or more, based on historical S&P returns and assumptions for the underlying floor and cap or indexed parameters, if it's an indexed UL policy, which we're going to use as the product type for our discussion here. But as Michael mentioned, just know that there are other types of life insurance policies, whole life UL, et cetera, that can be financed, but for the scope of this discussion, we're going to stay within the realm of IUL. So looking back, if we look at the 100% historical frequency for a product with a 12.25% cap and a 0% floor, going back to 1975, that floor and cap collar essentially would have realized a compound average growth rate of 6.45% or more in every 20-year rolling period beginning each trading day over that time period. And the same thing can be said for any of those other historical frequencies and the corresponding rates there. Now, if we look forward, what we like to use oftentimes is a tool developed by John Hancock called the IUL Translator, which the website for which is IULtranslate.com. It's a very effective tool. It basically uses a capital asset pricing model formula to price out the expected return of an IUL product based on its underlying equity risk, tied to your assumptions for equity returns in the underlying index going forward, inclusive of dividends. So if your expectation for the S&P 500, for example, is an 8% total return, including growth and dividends, then those would be the corresponding translated rates for those various indexing parameters there. So again, beyond the scope of this discussion, but just know that the algorithm that drives that IUL translation is based on the theory that assets with similar levels of risk should yield similar levels of return long term, and they have a very thorough white paper with some great supporting information to back up the underlying calculations. So those two columns that are highlighted there, we highlighted those because those are oftentimes where what we'll use to start with for projecting the illustrated rate. And what we find is that when you use the 100% historical frequency for looking back, it often translates to a similar rate of return based on an 8% total equity index return, which I think is a pretty reasonable assumption and expectation going forward.
So
the last thing,
one of the things that I just want to throw in here is that frequently when you're in the field and you're selling this stuff, you'll have an advisor, an attorney, accountant, somebody that's looking over the shoulder of the client. And frequently what we found is that they'll say something to the effect, well, run the return at 5%. And so what we begin to do is have a discussion like why you're saying that. And the reason they're saying that is just because 5% is just a small number, or, there's no rhyme or reason to it. What we've been trying to do is, in terms of stress testing, which we do a lot of, what we've been trying to do is say, we can stress the return, we can stress the interest rate, but now what we have is we have backup for various methodologies that we can apply to the illustration, and we have a rationale for why we're doing it versus just taking some random return or random interest rate. And so if you're in this market, this becomes really, really valuable and really, really powerful. And candidly, what we have found is that the other professionals that are counseling on the case, the attorneys, CPAs, family office, that very often they're impressed that there actually does exist a bunch of different historical futures, looking forward methodologies that we can employ in order to do the stress test. Much more compelling than just throwing out a number and say, run the interest rate at this or run the return at that.
Yep, great point. And then the last thing we'll cover here before we move back into our design and show some different tested scenarios is it's also important to keep in mind that the various economics of this transaction are correlated, namely the interest rate environment and the potential for policy performance. Not going to get into the specifics of that, but if you look back and compare, historical interest rates versus historical either whole life dividend rates or universal life crediting rates, you'll notice that there's a directional correlation, not a direct correlation, obviously, but certainly a directional correlation where they all tend to move directionally over time. And so going forward, as interest rates rise, we would anticipate anyway that at some point, and of course there will be a lag effect because of the effect of the portfolio yield within a general account of an insurance company and current market rates, relative to current market rates anyway. But going forward, we would expect that higher interest rates should translate to higher potential for performance, whether it's a fixed crediting rate within a UL or whether it's an indexed UL where the insurance company is using that budget to buy the underlying hedging strategy that drives the cap and the participation rates and things like that.
So we just had a question. Somebody just typed in. They wanted to know if we finance whole life insurance. And so for those of you on the line, we know that the industry is predominantly financing index universal life. I've heard various statistics, but I guess I would be comfortable saying probably 70, 75%. We personally do a lot of financing of whole life. There are reasons that people like to finance whole life versus index universal life. So the answer to the question is yes, we finance it. I don't think we're going to cover it in today's discussion, but we can definitely have a one-off on it.
All right, so if we take some of those methodologies for projecting the borrowing cost and the illustrated rate and apply them to that more risky design that we started with, we can see what the effects would be on the long-term performance based on those various underlying assumptions. So if we keep the premium funding the same, but we simply project the borrowing costs based on the forward rates for 1-year LIBOR plus a spread of 185, which is the underlying loan rate assumption here for this design, the borrowing cost gets up to around just under 5% eventually. Keep the out-of-pocket cost the same and project the illustrated rate on the policy at that 100% historical frequency number for this product, which has a cap of 12.25%. What we can see is a much different result now than what we saw before, and really highlight some of the concerns that we expressed earlier. Namely, now, as a result of those modest stress testing assumptions, the policy cannot support a repayment at least within a 30-year period or more, which then begs the question, how's the client going to get out of this thing? Because at some point, the loan should be, with this long of a duration to life expectancy and beyond, there should be a plan to repay the loan at some point. So that's the first question, is how's the loan going to get repaid since the policy now cannot support it? The other two concerns now is the much longer exposure to collateral risks inherent in this outcome. Before it was right around 10 years, now it's almost 20 years. And then also the death benefit falls short by 20% or more.
So I mentioned in the beginning that if you've heard us speak in the past, we typically talked about not liking this design, where in column 8, the client's paying nothing. So most recently in the past year, we've had a handful of cases where the clients were very affluent and the clients had very, very substantial amounts of cash on hand. In one case, almost $100 million of cash. And their contention was that when we showed them a design with a fixed payment, which we'll share, and then we showed them no debt service whatsoever, what really was affected is column 12, the amount of collateral. The amount of collateral got to be very, very significant. They came back to us, and this is where we began to think about it. They came back to us and said, look, I got $85 million in cash. If the high point of my collateral, instead of being $2 million, is going to be $5 or $6 million, what's the difference? I have $85 million in cash. Very, very rich, very, very sophisticated, very, very familiar with the markets. And so, you know, after going back and forth, and we also had a carrier that would approve no interest payment. You know, we agreed and said, you know what, in your particular case, it makes sense. So we're not really switching and saying we're advocates of people should not have debt service. What we are saying is in some scenarios where the client is really stock heavy with a lot of cash, and that cash is not going to be used for anything but posting collateral for the most part, it may in fact make sense. Now that we've said that, you know, most people on the line may or may not know, most carriers do not allow this design, that they do want to see some form of debt service. And so there are only a couple of carriers that we know of that will allow this design. Second thing I just wanted to add to this is that we're also big advocates, and as we continue to go through this presentation, where most people are showing exiting from the cash value at some time in the future, most typically years 14, 15 through maybe 8, 19. We're also advocating that what we should be doing is suggesting to the client that the premium that they're not spending, in this case $665,000, that they take it and actually create a side fund, either real or hypothetical, and put that money back in their business of whatever return that they're getting. And typically that's a big number. And what we're further suggesting is you monitor the premium finance transaction. This page, what we're doing with our clients is we're going back on an annual basis and we're saying, where did the interest rate go, column 5 versus where we thought it was going to go? What was the return on the policy versus what we thought it was going to be? And what's the long-term effect of that? And so in effect, the client may decide to put in more money. The client may decide to do something differently. And we're going to talk a little bit about that in the next few slides.
Yep, and before we move on, we just had a question come in through the chat feature as well. The question is, why do you increase the loan rate for only 15 years and not continue over the life of the plan? If we go back to that forward rate projection, the forward rates were projected for 15 years, so we just level it off thereafter since it's very hard to predict or have any reasonable reliability in predicting interest rates beyond that point. But also, secondly, it's not necessarily about the length at which you project the interest rate increase. It's more about, I think, at least in our opinion, the relationship between your ultimate projected borrowing cost and the ultimate return on the policy. Because when you look historically at the relationship between those two numbers, an IUL, a typical IUL product would have probably exceeded, based on empirical and hypothetical looking back evidence, would have exceeded the cost of borrowing by roughly 200 to 300 basis points. We don't generally like to illustrate that high of a spread between the two, but we do like to show some type of a realistic relationship between those two numbers. Again, taking into account stress testing and being conservative, and what happen if that spread is smaller than what it was historically. But that's essentially our thought process there for the projection. Okay, moving on. Now, if we, and on that note, actually, if we project the borrowing cost, instead of using the forward rate 15 years, we project a faster rising borrowing cost up to the 25-year historical LIBOR average plus the spread to show a smaller relationship between the crediting rate on the policy and the assumed long-term cost of borrowing. The collateral exposure is extended even longer. Again, a much lesser ability to exit from the policy, requiring potentially more funds from outside sources to repay the debt at some point, and then the death benefit falling short by an even greater extent. Another question came in as well. Do we continue rolling forward the 15-year interest rate projection during the annual review process? Michael, you want to answer that real briefly?
Say it, I apologize. I got distracted for a second because I was reading a question for myself. Say it again. I'm sorry.
During the annual review process, do we continue rolling the 15-year interest rate projection, or maybe said differently, continue projecting a rising interest rate?
So during the annual review process, yes, it depends. So what we're really trying to do here is we're really trying to get a grip on what's really happening in terms of the interest rate on the loan and the return on the policy, and continually monitoring that. If the interest rate is growing significantly faster than we ever anticipated, then what we're going to have to do is project that out and see what impact it has. So maybe, the answer is maybe. And you know, if you think about this, candidly, the interest rate rising scenario is really something that is really, it's just been happening over the last several months. We've been operating in a pretty stable interest environment for the last 8 years. And so one of the reasons that, Michael and I and, people in both of our firms have been spending a lot of time in terms of, trying to figure out not where rates are going, but what the impact is going to be and how we're projecting it. So yes, we would consider, increasing the interest rate higher than what you see here if in fact, we felt that what the environment was holding in store for us. So I just want to, I do want to point something out. I do want to point one thing out here because I don't want this presentation to come off as negative. We're not trying to defeat our success in terms of selling and doing premium finance. What we're simply trying to do is say that there are a lot of people out there that are showing really thinly funded policy illustrations with no debt service, and we think that it's dangerous and we think that it's going to have big impact in terms of deals failing. And everybody on this line knows that, when you have bad reputation in part of what we all do, sell life insurance or investments, whatever, it affects all of us. And so we're just simply pointing out here, there are a lot of ways to project more conservative outcomes and have the client prepared to either increase the debt service or increase the collateral or do something other than what's originally projected. The one thing everybody on this line knows, we've all been saying it, once you buy an insurance policy, the future of the original illustration is different, and the same thing is in premium finance. In one particular case, we worked on a case, we had the good fortune of working on a case with the Rockefeller Foundation, and we met with them, and it was really pretty interesting that they really loved what we were showing them, and it was on an older couple, and they asked us to stress it, and we said to them, well, how do you want us to stress it? And they said, well, we don't know. We don't do this every day. You tell us. And what we did was we ran, just as an example, we ran the 100th percentile return, less 50 basis points. So actually 50 basis points than it's ever been. And then we assumed a 0 return for 3 years. So we maxed out collateral for the 3 years, and we thought that that was a good stress. But it really depends on the client and the particular situation.
Yeah, and I think along that line too, I think risk management is obviously very important in monitoring these transactions, and I think a lot of the risks can be minimized by proper expectation management up front, vis-a-vis the various scenarios that are being shown to the client as far as what can happen when things go right, but also what can happen when things don't go as planned. And then before we move on, there's been a few questions that have been asked about whether the slides will be available after the webinar, and I believe that is the case, that they will be available through AALU.
Yeah, so somebody just asked the question, can you replace an index policy used in a premium finance deal if the carrier changes caps or increases mortality? So the overall answer to that is you can replace a policy the way you can replace any policy, but the second part of the question is that does the lender have a say in that change? And the answer is absolutely. Remember, the policy cash value, the policy and the policy cash value is the primary collateral, so the lender absolutely has control. If in fact you wanted to do that, you'd have to have the lender sign off on it.
All right. Last question. It's come up a couple times. Which carriers will allow 0 out-of-pocket outlay? There's really only a couple. Minnesota Life and Allianz, I think, are really the only that will consider that type of a design. It's pretty rare. Most carriers want paying full interest, or at least paying something meaningful towards debt. Okay, so now let's talk about.
Mike, I just want to say, I will add one thing to that. There are carriers that do demand interest being paid or some form of a stabilized cash flow. We have had discussions with numerous carriers where we've gone to essentially present them with a fact pattern and a client where we felt that we wanted to break their. I'll give you an example. We just funded a case last week with a carrier that wanted full interest to be paid. And what we did was, instead of paying full interest, we established this particular cash flow. And what they came back to us and said is, if the cash flow you're establishing is equal to or greater than the interest for the first 5 years, we'll be okay with it. And we said it is. And so what we were doing was overpaying interest in the first 5 years and then underpaying later on. But the client had serious skin in the game. It was a real number. He said, fine, we're okay with it. So some carriers are a bit flexible, and if you can present them with the case facts that are really compelling. Some carriers we found have some flexibility in terms of cash flow. So that being said, actually, this is now what we did was we began to take this illustration that we've been looking at, and this is the beginning of making it look a little bit stronger. And so what we're doing is in column 2, we're now funding for 10 years. So that's meaningful because we're putting in, I think the first one was 7 years, so we're putting in 3 more years. In column 8, we're establishing a fixed payment of $75,000 a year for 14 years. Now, what you see here is in column 6, you have the interest that's due, but in column 8, what we did was instead of paying the interest that's due, we paid a fixed amount of annual payment. And if you think about this in the sales process, clients are willing to pay. Sometimes they'll push back about starting a payment of $23,000 for interest that grows to 4.25. More often than not, it's not just the growth of that payment getting really large, but they want stability. So very often what we do is we present column 8 and we pick a cash flow or say to the client, what are you comfortable paying? And in this particular case, $75,000 a year, that's a real number, that's skin in the game, and most carriers would be okay with that. And so what you see the result of that is by extending the premium payments to 10 years, we use forward rates, so we're growing the interest rate. We have a fixed payment of $75,000, and you see a couple of things happen, and we ran it at the AG 49 of 7%. And so if you look at column 12, you know, the red numbers of collateral is now only going for 7 years versus I think we were up to 15 or a little bit more. The death benefit all the way through exceeds the amount that we were guiding toward of $10 million, and we can exit the policy loan with using cash value in the 14th year. And so what we have here is what I think is a much more stable, much more realistic scenario.
Yep, and one that has much less inherent risk as well, for the reasons that you mentioned. But also, if you look at the loan-to-value ratio at the point of the exit is much less, which gives the policy much more of a buffer to absorb the ups and downs or the variability within the collar, basically, over time. And there's also much less of a debt-to-equity ratio, essentially, overall, when you look at the relationship between the projected loan and the net death benefit of the strategy. So much leverage overall as a result of servicing the debt long term. And then another thing that we do in the analysis and in the presentation is we do a very thorough collateral projection as well. Now, we don't have the time to go into the details of this, but just know that there's always a mismatch between when the illustration calculates cash value and when the lender calculates cash value for collateral purposes. The collateral projections of a financing ledger can never be a reliable source for precise collateral calculations because it's always going to vary and there's always going to be that mismatch. But just know that we do project out what the high point collateral will be to make sure that the client will have enough liquidity in the future to cover the collateral needs outside the policy. And then we also project the collateral at the minimum guaranteed crediting rate of 0% or 1% if it's an IUL product, depending on the product type. And we'll use that as a way to set the initial collateral expectation by projecting 2 or 3 years out and kind of using that number as the expectation up front to make sure the client has enough assets comfortable with the amount of collateral that will be needed in the first few years.
So as a general, go back 1 second, please. As a general rule, that if you do a collateral stress test and the client, if you look at column 8 and column 10 real quickly, if the client doesn't have the ability to post column 10, you probably shouldn't do the transaction. Column 10 is probably a long shot of ever occurring. Column 8 is probably more realistic, but the client needs to be prepared that the collateral number may go up. And what you don't want to do, you don't want to have a client forced out of the transaction down the road because they have no more collateral to post. So this is something that we call a compare. This is just a brief shot of it, but in every premium finance transaction, every life insurance transaction, if you think about it, the client has choices. One choice is that the client can do nothing. The other choice is the client can pay the premium, and the other choice is the client can finance the premium. And so what we do is we want to prove out beyond the shadow of a doubt in a premium finance transaction that financing is the way to go. And what we do is we do various compares. We do death benefit compare, cash value compare, retained asset compare. So in this particular case, if you look at what's on the screen, the total gross payments for the finance policy is $1,050,000. And if the client went out and just bought probably one of the most inexpensive policies they would pay in between inception and life expectancy $3 million plus. And so what you find is in the finance transaction, the client has almost $9 million of cash. versus $1.8 million where the client's paying the premium. The IRR on cash value is 9.26 versus negative 3% plus. And the death benefit in the premium finance transaction is $15 million versus $10 million in the pay transaction, with an IRR of 11.5 versus roughly 6.5. And so what we're doing here is we're saying that, you know, if your choice is to go out and pay for the insurance versus financing it, it actually is, if you take a look at this and you believe the numbers, a much worse deal. Put in $2 million more in order to get, you know, roughly $6 million less in cash value and $5 million less in death benefit. Now, I can tell you, you know, I'm the guy in the field. I can tell you that we always run compares on all of our transactions. And I can tell you that we've had numerous transactions where it actually proves that financing is not the way to go, that you're better off just paying for the premium. And so there's no hidden agenda here. We just want to prove out one way or the other, which is the better transaction for that particular client.
And oftentimes what a business owner or an entrepreneur or a real estate investor may look at that $3 million under the non-financed scenario and think is opportunity cost. Could they have done something better with that money long-term in their business or other more purportedly more lucrative investments? So one of the ways that we will demonstrate the advantages of the financing strategy from that perspective is to do the comparison of retained assets, where that we show the same outlay being applied to both the non-finance and the finance strategy, only in the finance strategy. The difference between the premium that would otherwise have been required out of pocket for a non-finance transaction is assumed to be either invested or retained and invested within their business, within other investments or real estate or whatever other type of asset profile makes up their overall financial assets. We'll assume that there's some type of growth that occurs on the cost savings, essentially, that they're able to realize through the financing transaction and what the future retained wealth would look like relative to paying the premium. So in this case, assuming an 8% growth rate, which oftentimes is conservative for very successful entrepreneurs, by investing the cost savings, the difference between the otherwise premium and the interest expense on the financing strategy would yield roughly $6.2 million of retained capital at life expectancy. And said differently, $6.2 million would be the opportunity cost of paying the premium out of pocket versus using leverage. So a very effective way to demonstrate the other financial advantages long-term of using leverage. So now let's move through.
Go on.
Yep. So let's move through some of the next scenarios kind of quickly because we're coming short on time here. Now what we're going to do is show you some other scenarios where we just use different assumptions to show some stress testing and some different outcomes. Starting with here, keeping the borrowing cost at the forward rates, keeping the cash flow the same, but pushing down the crediting rate to that 100% historical frequency of 0.45%. What we see is that the transaction still succeeds long term. It just, the point of loan repayment by way of the policy just has to be extended for a couple years, from year 14 to year 16. But still a very successful transaction long term in terms of IRR, cost savings, et cetera. And if we project the borrowing cost instead at the 25-year average and grow it a little bit quicker, again, still a successful outcome, just have to wait a couple more years now in order to repay the debt. So this is a great example that shows that if things don't work out as planned, if the policy underperforms, or if the from what was projected, or if the borrowing cost goes up higher than what was projected, it doesn't necessarily mean that the transaction fails. It just means that maybe we have to pay a little bit more out of pocket for the loan, maybe have to pay a little bit longer, or wait a couple years in order to exit the loan, or some combination thereof.
So just if you think about this, and we mentioned this earlier in the presentation, most people that are engaging in a premium finance transaction have used leverage to create wealth. And so if you're monitoring this thing on an annual basis, you might say to the client, you know, $75,000 a year is you're going to have to now go out to 18 years. You're not going to be able to do 14 years. And the client has the opportunity to say, well, what happens if I put in 100? And that's the conversation in real life that actually does occur. That if you're monitoring this thing on an annual basis, then the client can say, okay, what happens if I put in 100? What happens if the rate of return isn't 645, the 100th percentile, which is pretty stressed? What if it goes back to, 6.8, 7.2? And these are the kinds of conversations that we're having on the annual review. My experience has been that as long as the client knows upfront that we're going to be doing these annual reviews and that there's some tweaking needs to occur as we, move toward the ultimate termination of the bank loan, we haven't had a problem. Most of the people that we're dealing with are set up in order to be able to behave this way, and we find it's very effective. The concern that, you know, I would have is where you enter into a premium finance transaction and you don't look at it, or you just let it sit, you know, and just see what happens. And then, you know, you wake up one day 10, 12, 15 years down the road and have a big oops moment and, you know, a lot of unhappiness and a lot of litigation.
And so if you recall, the first scenario we showed with this cash flow was showing the loan being repaid in year 14, at the end of year 14. Let's say that the client were to decide over time, if we keep the borrowing cost at the 25-year average and show that 100% historical frequency, and the client got out to year 14 and said, yeah, I really just want to get out of this, get out of the arrangement just to, you know, mitigate any potential future risks and whatnot, or just keep to the original plan schedule for the duration of the loan exposure. In this case here, based on those stress tested assumptions, in order to fully repay the debt at the end of year 14, we would have to come up out of pocket with an amount, in this case, roughly $800,000, in order to allow the policy to continue to last based on reasonable assumptions. So again, coming back to that, you know, maybe you pay a little bit more, maybe you pay a little bit longer, or some combination thereof. In this case, it just shows that that the client may have to come up out of pocket with some additional funds to help repay the debt in order to meet a desired exit point compared to what was originally illustrated. But that doesn't necessarily, again, mean that this transaction failed, because if you look at the IRR long term, it's still very meaningful and very compelling. And also, if you look at kind of on an annual projected basis, that retained assets analysis, there's still significant, even despite coming up out of pocket with an additional cost, there's still significant retained assets long term. And at the end of year 14, beginning of year 15 there, when it shows that additional $800,000 being paid by the client compared to what was originally projected, there's still considerable retained capital long term based on these underlying projections.
So in the next slide, we're going to have to start moving because we are going to run out of time. So on the next slide, what we're showing here is that one of the things.
Sorry, a little delayed.
Okay.
There we go.
Okay. One of the other things that we're doing that creates less stress on the policy is, if you could column 2 and 4, what we're doing is we're exiting the loan over a period of years instead of 1 year. And so what that does, it relieves some stress in terms of the long-term performance of the policy. Just a tool that we use where it just gives a better effect sometimes going long-term.
All right. Showing the client having to pay a little bit more or a little bit longer or some combination thereof brings up the question that we brought up earlier: how do we create additional sources of loan repayment by implementing some backup plans, basically? We don't have time to go into the details of these. We're just going to run through these really quickly here. The first of which we already talked about, which was using the future value from retained capital. In other words, the invested cost savings over time, either reinvestment in their business or invested in other assets. There's going to be future wealth there created that can be used as a source of repayment. If there's a planned liquidity event at some point in the future, such as the sale of business, that can create some cash flow to provide a backup plan. If the policy is trust owned, the client can make additional gifts under the kind of the same premise of bullet points 1 and 2 there to the trust, either annual gifts or lifetime exclusion gifts, etc. And maybe more using more sophisticated strategies. If it's trust owned, we can plan to have the remainder values from a GRAT or a CLAT spill over into the trust to provide future cash flow and liquidity. And then lastly, one of the more common techniques used in the estate planning world, as many of y'all probably know, is selling interest in an entity to an intentionally defective irrevocable trust, which can, again, just create more assets or cash flow within the trust at some point down the road, either by making a distribution from the entity to the trust or distributing assets, et cetera, that can be used as a way to create that backup plan. And one of the most important things, I think, or I guess I should say another important thing, is that if the client is not willing to consider implementing any other strategies to provide just a plan B, basically, in case plan A doesn't work or doesn't work to the extent that it needs to, and it might be a situation in which you want to have a pretty tough discussion with the client and consider maybe not financing, because it's very important to have contingencies in place in the event that the strategy underperforms.
So we had a situation a few months ago where some agents came in from one of the whole life companies. It was not a particularly the whole life policy was not particularly performing well. And so what the agent said, because they wanted to really force whole life, in this particular case, not a really good whole life policy, the agent said that the client was willing to sell real estate in order to exit the loan, because there was no way they were going to be able to exit using the cash value. And we were concerned about that because, what if what if the real estate market's down when it's time to exit the loan? Or what if credit's not readily available, or a million other things that could occur? And, the agents kept arguing with us that don't worry about it, he wants to sell the real estate. And we did a conference call with him. And in fact, it was absolutely not true. He said, I feel that it concerns me that I'm going to have to be forced to sell real estate to exit the loan. Point being that if you're not going to use the cash value to exit the loan, you need to have something that's going to be reliable. Remember, we're exiting the loan 12, 15 years from now. And so we need to know that if they have cash or they have some method to repay all or part of the loan, not using the cash value, that's not going to be dependent on, real estate market or something like that.
So in our last few minutes here, let's talk about an idea that we feel can be very compelling, regardless of whether the estate taxes are in effect or not. So again, we're not going to get into our opinions on that, but what we're going to do is show you a design here that can be really attractive either way, and really reinforces the flexibility of the strategy and the advantages of using this type of a strategy in a way that can be used to either cover estate tax needs if there is an estate tax concern, or maybe a capital gains tax at death, et cetera. Or if not, I think we can all agree that income taxes are definitely not going away. And historically, even if income taxes go down in the near future, there's still a very viable need to diversify one's wealth from an income tax perspective. And if you look historically, when taxes have gone down, that's usually accompanied by a reduction or an elimination of certain tax deductions in order to help subsidize the decrease in the tax rate. And then subsequent to that, historically, if income taxes ever went up following a decrease, typically the deductions don't come back, which I think is really important going forward. If taxes do go down, chances are some deductions may go away. And if income taxes ever go back up in the future, which could be very likely if there's a political change in Washington, or depending on the extent of future revenue needs of the federal government and everything like that, it could be possible that deductions don't come back, which further reinforces the need for tax diversification with one's wealth. So we're going to start with that premise and show a design that we've been having a lot of success with lately, designing instead of for maximizing the death benefit long term, maximizing the cash accumulation with the potential for taking supplemental tax-free income.
So what we're doing, you got to go back.
There's a lag in the timing here.
So what we're doing here is we're actually recommending a $6 million policy, and we're recommending the client pays $100,000 a year for 10 years. And what the ultimate goal here is at the onset is that the client's going to have supplemental retirement income. So in this particular case, what we're doing is we're creating $398,000 a year for 20 years of supplemental income, starting in the 21st year through the 40th year. We use the forward rates to be conservative, and we ran this at 645, which was the 100th percentile. So it's pretty stressed right out of the box. And with all of that stress, we were still able to exit the loan in year 16, one exit instead of multiple years. And what we did was we reduced the death benefit somewhere around the 16th year. So in real life, we've done several of these. In real life, what's happening is that when a client is interested in supplemental income, what we're doing now is we're always running the supplemental income illustration. We see it here, but additionally, we're running without reducing the death benefit and without taking the income. That what we found is that everybody that starts out with supplemental income wants to have that option of either taking the income or maintaining the death benefit. So in this case, just as, for argument's sake, if in fact we started with $6 million and we were going to go down the supplemental income road, we would reduce the death benefit somewhere around the 16th year, maximize the supplemental income. But in reality, what the client may say is, I don't need the supplemental income because I have so much money. I'm now concerned about estate taxes because there is an estate tax, so let's waive the supplemental income and let's keep this as a death benefit play. The beauty of it is that nobody really cares on day one which way it's going to go. We're just monitoring annually in terms of both scenarios.
And a couple other quick highlights here. Because the plan is to have the potential to take additional income from the policy in excess of what's used to repay the debt, we're usually a little bit more conservative in this type of design with respect to the leverage ratio of premiums borrowed versus loan payments made by the client out of pocket. So we're showing borrowing $300,000 and paying 100, as opposed to before we showed borrowing roughly 600,000 and paying 75. So we're even a little bit more conservative to make sure that we're managing that loan to value ratio long term, and not taking too much money from the policy to risk the policy lapsing. And if we were to do that comparison again that we talked about before, and if the client were willing to pay $100,000 out of pocket and just applied that as premium instead, as you can see here, this is what we call the cash flow plus scenario, where we take the same cash flow, apply that as basically the loan payments, and then show how much more income we could generate with financing. In this case here, by paying the premium out of pocket, or applying that $100,000 as premium out of pocket, we'd only be able to get roughly $250,000 of illustrated income. So there's meaningful leverage here in terms of income and cash value and death benefit long term. And then conversely, what we can kind of flip that comparison, and instead of designing the financing strategy to match the out-of-pocket cost of what they would be willing to pay in premium, we can instead apply or borrow enough and generate enough performance to create the same cash flow, retirement cash flow long term, but for less cost up front. And I apologize, the internet here is being really laggy, so it's not going on to the next. There we go. There we go. So if we structure the strategy to generate the same supplemental income, we could do so at a cost that's roughly 40% less based on the same underlying assumptions here. So we save them roughly $400,000 over 10 years to create the same illustrated retirement income or supplemental income down the road, but for much less cost, and even get much more death benefit long term as well. Another thing that we like about this.
No, I was just going to say, we have found that this is one of the most compelling sales that there is, that if you have the right professional, as an example, you know, if you think about a doctor who's an independent doctor who's looking for some more supplemental income, doesn't want to cover the staff with more qualified plans and stuff like that, this is an extremely compelling sale. We actually presented to a litigator here in Miami, sole practitioner, and he loved it so much, he actually suggested that he was going to get licensed and take us to all of his friends and, you know, sharing the commission. Whether or not that's going to happen, I don't know. But I mean, he thought it was the greatest thing he ever saw.
Yep, and another thing we like about this design too, just from a collateral perspective, because there's much less leverage being shown relative to the payments being made by the client. There's much less of a collateral exposure long term as well. Even in column 10 there, projected out at the guaranteed 0% return for 10 years, there's still only roughly a max collateral exposure of $80,000 to $200,000, depending on the year reference there. So very low collateral exposure, in addition to getting the very attractive potential benefits of using leverage. All right, and this is, I think, redundant at this point. Again, just demonstrating the additional benefits achieved through the leverage for less cost. Now, as we mentioned earlier, one of the great things about this strategy is the flexibility to either reduce the benefit, use it for income or cash accumulation, or just continue to let the death benefit grow unreduced. Say, for example, let's say estate taxes go away, but they come back. Or maybe estate taxes go away and they're replaced with a capital gains tax at death, et cetera, or whatever, or maybe they don't go away at all, who knows? The flexibility of the strategy here allows the client to make that determination in the future as to what extent they want to use it for death benefit to cover estate planning needs, income to cover any, you know, lifestyle needs or income tax related needs during life, or some combination thereof. And as Michael mentioned, we oftentimes, or almost always will, or at least the client will almost always ask, what would this look like if we didn't take income and didn't reduce the death benefit? So very compelling.
So we just had a question. I'm sorry, Michael. We had a question. I thought it was appropriate. So what the question was, can we do spread commission in order to reduce the amount of collateral? And the answer is yes. We do a lot of transactions where we're using spread commission. I assume everybody here knows what that means. And get more cash value up front, which lowers and lessens the amount of collateral the client has to put up. So I'll just add a personal note to that. It occurs to me, if in fact you are premium financing because the client has a better use of their money, typically invested in their business, then it might make sense always to use a spread commission and reduce the amount of collateral the client has to put up, because that also could be reinvested in their business, you know, achieving a higher return than within the policy. So the answer is yes, we can do that.
Great. And we've had several other questions come in too, but unfortunately we just don't have the time to get to all of them, but we'll do our best to follow up individually afterwards. All right. So now if we stress test it even further, show the 30-year average borrowing cost, which pushes the ultimate projected borrowing cost up above 6%, keeping the year of repayment the same. Client comes up with additional out-of-pocket costs, kind of the similar premise that we showed before, but just really reinforcing still the the expectation of things could be different than what we project and may cost more than what we project, et cetera. But even in this case, for example, being even that much more conservative with respect to the relationship between the borrowing cost and the crediting rate, and the client having to come up with a little bit of additional out-of-pocket cost, we've still, in the long run, saved the money. Because if you recall, to get to $250,000 of illustrated income, it would have cost the client $100,000 per year in traditional premium payments. But in this case, we saved them $400,000 over 10 years, and they only had to come up in 15 years from now with an additional $242,000. So they've still saved money, and from a retained assets perspective, still created significant retained capital long term because of the ability to invest or retain that cost savings in whatever other type of investments that they may have in their overall estate or financial portfolio.
So I'm going to hit a couple of questions really fast. There's too many to hit, altogether. So one of the questions that somebody asked is, what's our involvement ongoing? So we have numerous ways that we work the cases, everything from working jointly 100% to just providing the financing. But in all three ways that we work, which I'm not going to get into now, in all three ways we work, we annually maintain the policy for the life of the policy. That's the intention, that we're going to be involved on an annual basis. The second question related to that is, do we charge an annual fee in order to do that? And the answer is no. We get paid up front as part of the commission. We take a piece of the case, and that, sustains us all the way through.
All right. So let's go ahead and put all these up on the screen here. We don't have the time to go into all of them because we're about 2 minutes over our time here. Michael, anything you feel really important to reinforce or highlight based on what we talked about before we wrap up?
No, I just think, in our practice specifically, we have not had very much chatter about the potential of the estate tax staying or going. So, I have no idea what it's going to do, but we think that, regardless of what happens with the estate tax, there's still going to be death benefit need for life insurance, supplemental, charitable, nonprofit. And so, in terms of our business, it hasn't affected us at all. I'm not sure, but I've talked to some people in the market, and they said that the effect that they've had with the new administration is really things are moving at a slower pace because people want to see what's going on. Don't have any answers for that. But, the overall point here was that we are in an environment with interest rates rising, with a lot of unknown about what's going to happen with taxes in the economy, but we still think that there's huge opportunity for premium finance just as much as before.
And gentlemen, thank you so much for a very informative hour this morning. So appreciative of your time today, and we do look forward to seeing you both in just a couple of short months. Again, to anyone on the line, if you do have specific questions about AALU's positioning on any of the issues addressed on today's call, please forward them to communications@aalu.org. If your question, if the submitted question was not answered, we will be providing the list of questions and those who asked them to Michael and Michael for follow-up. So hopefully you can connect separately. And I do want to make it clear that the recording and the slides from today will be made available later this afternoon once everything is rendered. So look for an email from AALU with all of that information. Thank you again to our presenters and to all of our participants, and I hope you all have a wonderful afternoon.
Thank you. Thank you very much.
Thank you.